Now the further classification of capital market. Capital market is further classified into two types of market. One is primary market and the second one is secondary market. What primary market is? Primary market is a market essentially, helps in raising long-term capital, right? In primary market, securities are sold for the first time by the issuing company. Any company which is issuing shares, debentures or any kind of bonds for the first time in the market, right? Now, in primary market, securities are directly issued to the investors, right, by the issuing company. Okay. Company raises fund by issuing shares, debentures or any kind of bonds. Shares can be equity or preference. Fine. Now, as I told you that in primary market securities are sold directly to the investors. Now question raises that who are the investors in the primary market? Investors can be any bank, any financial institution, any insurance company or the individuals. Fine. So these are the investors in the primary market. Any company issues securities for the first time, and these securities, they are sold to the investors like banks, any insurance company or individuals, right? Funds are raised through shares, debentures or any kind of bonds. Now why this whole process takes place, right? The whole process actually takes place for the purpose of expansion, diversification, modernization or any kind of investment in real assets, right? So a company goes through the whole process for this particular process of expansion, of diversification, modernization or investment in real assets, right? In primary market, again we have discussed in the previous lecture also that surplus unit, it also, this primary market also links the surplus unit with the deficit unit. The same process is there. It transfers, it helps in transferring funds from surplus unit to the deficit unit. Deficit units, they put the borrowed fund to the most productive uses, maybe for purchasing real assets. When they purchase real assets, they make any kind of profit out of that. It hence, it further helps in the capital formation. Fine. Then after that, any kind of capital formation leads to the growth and development of any nation or economy, right? Now there are methods of issue of securities in capital market. As we discussed that the issue of securities is basically, or the capital market, it operates under the guidelines of SEBI, Securities Exchange Board of India. It regulates the operation of capital market as actually regulated by SEBI. So how securities are issued in capital market under the guidelines issued by SEBI, right? There are two methods of issuing securities in the primary market. If a company is, for the new companies or for the existing companies, right? If any new company is offering, or if any new company is raising fund through issuing any kind of shares, debentures or any kind of bond, right? That is called the IPO, initial public offer. This company is new and it is coming up in the primary market to raise capital through the issue of shares, debentures or any kind of bonds. So this is called the initial public offers. Fine. Now IPOs or initial public offers can be made through in two ways, right? The first one, if a company is directly approaching the public, fine, or second, they are involving the intermediaries. Now who are the intermediaries? They are the brokers or the underwriters. Fine. For existing companies, how securities are issued, if existing companies, they are raising capital through the shares or debentures, issue of shares or debentures. The first one is the right issue and the second one is the preferential issues, right? So these two methods, they are mainly for the existing companies, or there are some people who have share of the existing companies, so they get these two kind of things, that is right issues and preferential issues. IPOs, they are, what do? They directly public issue through prospectus. When IPOs are there, or when any new company is coming up with the initial public offer, they directly issue a prospectus, right, wherein prospectus is containing all the information related to any issue of shares or debentures, or the market position, financial position of the company. So it contains all relevant information which any stakeholder or shareholder requires before investing in that particular company. Fine. Under right issues, two methods are again there. The first one is the offer for sale, and the next one is the private placement. So we'll be discussing in detail the whole chart, or how the securities are issued by the new companies or by the existing companies. Fine. So we'll be discussing this particular chart in detail in the next lecture. So the methods of issuing securities in the capital market or in the primary market. The first one is the public issue through prospectus, right? Any company which issues prospectus, why a company issues prospectus? A prospectus is issued by a company to attract and inform the general public, right, to subscribe for the securities of the company. So by issuing prospectus, a company is actually informing and attracting the general public to invest or subscribe the securities issued by the company. These securities must be listed in the stock exchange. Fine. What informations are generally contained by a prospectus? Prospectus is having all the details about the purpose of raising the fund or the finance. Fine. Second one is the background of the company. Third is the past performance, the past financial performance of the company. And these informations, they are mandatory to be provided by any company which is issuing any prospectus for fundraising purpose, right? Why they are mandatory? Because SEBI has provided the guidelines for the same. These informations are provided for informing the general public, so that they can evaluate that where their money is going to be invested, right? And when they go through the prospectus, the general public or the investors, they come to know, they understand, they evaluate that their investment would be profitable, right, or risky, right? So the component or the chances, or you can say that the risk and the profit, what is the quantity of the risk involved or the profit involved in the proposed investment. So that's why this prospectus is it has to be provided to the general public. When any company issues prospectus for the general public for raising fund through the issue of shares or debentures or any kind of securities, some intermediaries are also involved. Intermediaries like bankers, underwriters, and the brokers. Fine. So these intermediaries, they facilitate the public issue. Fine. The second method is the offer for sale, right? There is a process of this method or involved in this method, that any company which is issuing securities, they sell securities at an agreed price, right, or at a fixed price to the brokers. First, they don't sell the securities directly to the public, but they sell their securities at an agreed price to the brokers. Brokers further sell these securities to the general public at a price higher than the price they have paid to the issuing company. Fine. So in between, as an intermediary, they make certain profit out of it, right? Now the question arises that why any company involves intermediaries or the brokers to sell their securities. Fine. The advantage is that a company gets relieved of the tedious and lengthy process of formalities involved in the making a public issue. Fine. So that company, it relieves itself from any, that lengthy process of making any kind of public issue. Third method of issuing securities is the private placements. Right. In this, the company which is issuing the securities, they sell the securities at a fixed price to an intermediary. Intermediaries can be broker, bankers or underwriters, and these intermediaries, right, or brokers, they sell these securities at a higher price to the selected clients. Fine. The investors whom these intermediaries they approach, right, they are generally the LIC, UTI, GIC, means the life insurance company, Unit Trust of India, General Insurance Corporation. Fine. These selected clients, right, they gather information. Fine. They evaluate the gathered information in order to find out the risk and the profit involved in the investment, the proposed investment, and if they are convinced, they buy the securities. Fine. Generally, this method, private placement method, is a cost saving method. Why? Because it helps, it helps in saving, right, saving the expenses like the underwriting commission, fees of the manager who will be responsible for the issuance of the securities, and the advertisement cost involved, or the registrar fees, right. So all these expenses, a company doesn't have to make such kind of expenses when that company is opting for the private placement method of issuing securities. Generally, this particular method is used by the new companies because they don't want to spend on these expenses. Fourth one is the right issue, and that is meant for the existing companies, right. An existing company, they issue new shares. Fine. And when they are issuing new shares, first they have to give the shares to the existing shareholders, the shareholders which have already holding the shares of the existing company, means they have purchased the shares of this company in the past as well, right. So before issuing any new shares, such company has to first offer these new shares to the existing shareholders in a certain proportion of shares held by them. For example, if any shareholder is holding 5 shares, then he will be given 3 new shares. The ratio would be 3:5. Fine. You know why this particular method is called the right issue? Because it is a preemptive right of the existing shareholders that a company first must offer that new issue before offering it to the general public, right. So it's a preemptive right of the existing shareholder that a new company, if that is offering any new issue before offering it to the general public, right, that the new shares must be first given to the existing shareholders. It is mandatory under the Companies Act 2013. Fine. The fifth method is preferential issue. In this, a company or the securities are issued by a company to the selected number of people. This is also a method used by the existing company. In this, a company issues securities to the selected number of people, right. The selected number of people may be directors or the promoters, and the shares, the new shares, they are being given at a price lower than the price prevailing in the market. Fine. So this particular method fine, of issuing securities or the raising fund through issuing securities is, a method which is involving less cost, or funds are raised at a minimum cost. We have already covered primary market. Today we will be discussing secondary market. So what secondary market is? Secondary market is a market for the sale and purchase of previously issued securities, right? There are certain securities which are issued by a company to the investors, and this secondary market provides a platform to the investors who are there, who are there to buy and sell those securities. Fine. It is not the place of origin of security. So in the second market, the securities which are already issued, right, they are being transacted, right? The transaction of such securities which were previously issued by any company to the investors takes place. Fine. So in primary market, as we discussed earlier, that in primary market companies, they issue, right, securities to the investors, right? So there is a direct link between the company and the investors, and the transaction or the sale of securities takes place between the company and the investors. Fine. Whereas in secondary market, the transaction, right, or the sale and purchase of securities takes place between the investor and the investor. Fine. So one investor who is interested in converting the securities into cash, fine, such investor sell the securities to the other investor who is willing to buy the securities. Fine. So there is no direct link between the company and the investors, whereas the link between the investor and the investors who are willing to buy and sell their securities. So one investor to the sale and purchase, or the transaction takes place between both of them. Fine. By doing such activity, they convert securities into cash. Hence, it provides secondary markets, they provide liquidity to the existing securities. Fine. So if this particular market is not there, secondary market is not there, then such securities will not be encashed. Fine. So it provides a medium to convert such securities into cash. Fine. And the transaction, the sale and purchase, it takes place at a certain fixed place, that is called the stock exchange. Fine. The sale and purchase or transaction takes place at the stock exchange. Fine. And through a broker, right? In the stock exchange, there are some brokers, they bring together then both the investors who are willing to buy and sell the securities. Broker brings them together. Fine. And for providing such services, he charges the brokerage. Fine. Now there are certain more features of secondary market, like the securities which are traded in secondary market, they are traded, cleared and settled within the regulatory framework of SEBI. Fine. So it is guided and regulated by the framework of SEBI. Next feature says that secondary markets do not directly contribute to the capital formation, but it contribute indirectly. How indirectly? That it provides a facility to the investors that they can exit anytime from the market, and anytime by purchasing the security of any company, they can become a member of any company. Fine. If any investor is buying the shares of a company, right, through the other investor, so indirectly he is becoming the member of that particular company. So that's why it indirectly contributes to the capital formation. Fine. Now we will discuss about the difference between the primary market and the secondary market. There are certain bases. The first basis says the issue. Securities, they are issued by the company, as we just discussed that securities are directly sold to the investors. Fine. And there is a transaction between the investor and the company, fine. Whereas in the secondary market there is no issue of security, there is a buying and selling of securities, right? Buying, the second point is the buying. Only in primary market only buying is there, means one investor can buy the security directly from the company, fine. So there is no further selling. Whereas in secondary market there is both buying and selling between the investors, fine. Third point says the prices in the primary market and how prices are determined in the primary market and the secondary market. In the primary market the prices are determined by the management or the company, fine. Whereas in the secondary market the prices are determined by the force of demand and supply. For example, if a particular company is doing well, fine, their market share is really high, so the shares, the value of the shares of such company would be high, so that will be decided by the financial position or the market share of that particular company. So that is decided by the demand and supply of the shares in the market. Next point says the location. Location means how, where particularly the transactions takes place, fine. In primary market there is no fixed location for the transactions, fine. Whereas the transaction in the secondary market, they take place there at a certain place, a fixed place, that is called the stock exchange, fine, with the help of a broker, fine. The fifth point says the purpose. What is the purpose of the primary market, fine. The main purpose of primary market is to raise the long-term funds by a company, by issuing the shares of a company to the investors for diversification, for expansion, for modernization of existing project, right. Whereas the purpose of secondary market is to buy and sell securities by the investors. Securities means the shares and debentures by the investors. It takes place between the buying and selling of securities between the investors, fine, for the purpose of converting those securities into cash. Clear? Thank you.